Oil markets are facing one of their most severe disruptions in decades. The blockade of the Strait of Hormuz has removed a significant share of global supply, driving prices higher and reshaping trade flows, especially across Asia. At the same time, strategic reserves are being released and new supply dynamics are emerging. So, what does this mean for oil, refined products, and the global economic outlook? I'm Johanna Bota, and joining me today is Bruno Santos, Brazil Market Intelligence Analyst at StoneX. Welcome, Bruno.
Hey, Johanna, and everybody who's watching. Thanks for the invitation.
My pleasure. So, Bruno, we are now several weeks into the Strait of Hormuz disruption. How significant is the impact at this stage, and how has it evolved?
Well, Johanna, this is a very serious situation. To put some numbers on it, the Persian Gulf accounts for roughly 20 to 25% of global oil supply. So any disruption there has immediate global implications. Since the conflict escalated and Strait of Hormuz was effectively closed, we have seen part of that oil being redirected through alternative routes. Saudi Arabia, for example, have relied more on Red Sea ports and onshore pipelines. However, estimates suggest that only about 25% of Persian Gulf exports have been successfully rerouted. Data from the International Energy Agency shows that we had a reduction of around 10 million barrels per day of global production in March, which is directly which is directly focused on what happened in the Persian Gulf. The majority of those barrels that we see in Persian Gulf are now without a clear destination. So we are seeing nowadays that a lot of those producers are not only suffering logistical problems, but also production problems. Iraq is a clear example of that. The country announced an 80% cut in production since the beginning of the war, showing that the logistical problem are no longer only a transport issue. They are now becoming production losses.
Right. So, despite the disruption, though, Iran has effectively created a controlled corridor and is still managing to export its own oil, right? I mean, reports suggest that flows have actually held up even at a premium. But now, with the U.S. moving to block Iranian shipping, how does that complicate the situation further for global markets?
Yeah, so now what we are seeing is that those pressure on the physical prices are not coming only from the Iranian blockage, but also the blockage made by the US. So before this movement from US, we were seeing oil going out from the Iranian ports. Iran, even after the war, exported around and more than 1 million barrels per day. However, with this new movement by the White House, what we are seeing is a reduction from the flows coming from Iran as well. That being said, we are seeing a more stressed market, an even more stressed market, not only because we saw the lack of barrels coming out from traditional producers and really important producers such as Saudi Arabia, Kuwait, Iraq, but also now from Iran. So the problem now is higher, is bigger, as we continue to see this disruption extending to other countries. And the result of that, as I mentioned before, is higher physical prices and a higher differential between the prices that are practiced in the physical market and the finance market.
Of course. And well, we're also seeing releases from strategic petroleum reserves. Is this enough to stabilize the market, though?
Yeah, so just to provide some context, the International Energy Agency announced the release of 300 million barrels of crude oil coming from the strategic reserves. Most of those oil release was made by and are being made by US. This move definitely helps to reduce part of the supply shock, but the thing is that it doesn't fully solve the problem. The releases, considering the calendar, should add roughly around 3 million barrels per day to the market. And we saw the report from the International Energy Agency that there was a reduction of around 10 million barrels per day of global production in March. So the market is now still dealing with a meaningfully supply gap caused by the Hormuz disruption. From a market perspective, to be honest, the only real and sustainable solution to ease these supply risks would be the full reopening of the Strait of Hormuz.
Of course. And it seems like obviously everyone has been touched by this, but Asia in particular seems the most affected in this crisis. Why is that?
Yeah, so Asia is by far the region most dependent on oil flows coming out from the Persian Gulf. According to the International Energy Agency data, around 13 million barrels per day went through the Strait of Hormuz toward Asia in 2025, which represents about 40% of the continent's total oil imports. When those flows dropped sharply, governments across the region moved quickly to protect domestic supply. If we see China, for example, uh, rightly after the war, the beginning of the war, they announced a ban on gasoline and diesel exports, which also affects Asian balance. More recently, other Asian countries announced fuel consumption restrictions, particularly for jet fuel. And all of this actually highlights how concerned the region is about energy security and availability under the current conditions.
And what about key players like the US and Russia? How are they adapting?
Yeah, so in the United States, the most visible impact has been on exports. Data from the Department of Energy showed actually record high exports on petroleum products by late March, with both Asia and Europe increasing purchase of US supply. More recent, there were reports suggesting that US crude export orders have surged in recent weeks, reflecting exactly the disruption of Persian Gulf deliveries to Asia, Africa, and Europe as well. Russia, on the other hand, is widely seen as one of the winners with this conflict.
Yeah.
Exactly because before the war, Russia was struggling to sell its sanctioned barrels,
Hmm.
facing weaker demand in a well-supplied global market. Yeah, so we saw more producers coming into market and less consumers accepting to buy Russian products. The outbreak of the conflict, however, unlocked a large portion of crude that had been sitting in floating storage. India, for example, resumed purchase of Russian oil, and other buyers also increased imports. And even with the recent Ukrainian attacks on Russian energy infrastructure, mainly in the Western ports, we saw that Russia has managed to expand volumes and revenues, and this is mainly supported by this stronger international demand.
Can you explain to me why diesel prices are rising more sharply than crude oil?
Yeah, so since the conflict began, we saw that the contracts for heating oil going even higher than crude oil. One key reason for that is that the Persian Gulf doesn't only export crude, they also export around 5 million barrels per day of refined products, in which about 30% of that volume is diesel. And most of those diesel goes to Asia as well. This is especially worrying because global diesel inventories were already below historical averages before the war, particularly in Asia and Europe. So even with the end of the winter in the northern hemisphere, in the global northern hemisphere, and a seasonal slowdown in heating demand in US and Europe,
Hmm.
the expectations are of tighter diesel supply globally, and this affect prices as we are seeing right now.
Of
At this
course.
point, to be honest, there is still no clear timeline for when this imbalance could normalize, but we see that exactly because of these lower inventories worldwide, diesel is being more affected, not only for than crude oil, but also when we compare to gasoline.
Of course, that makes sense. And one last thing, Bruno, as we look ahead, and you can be as pessimistic or optimistic as you want, how do you see oil prices evolving under different scenarios?
Yeah, so unfortunately, Johanna, we do not know what will happen in the next day, even in the next hour. So, as I mentioned earlier, the main driver for oil prices in the coming weeks and months will be how the conflict in Persian Gulf evolves. If the conflict persists and restrictions on navigation through the Strait of Hormuz remain in place, we should see even more stress on the global supply balance, pushing prices even higher. At the same time, higher prices and limited availability could lead to a more demand destruction, as we are seeing right now, which is a factor that may limit more extreme price spikes in the short term. On the other hand, the escalation of the conflict and a
Hmm.
full resumption of flows from the Persian Gulf would likely trigger a sharp correction in oil prices.
Yeah.
Even in that scenario, prices would probably find a higher floor than before, since global inventories are expected to decline significantly by the time the conflict ends. Right now, what I can say that the most likely scenario that the market is accepting seems to be a partial reopening of the Strait of Hormuz, with Iran controlling access through a toll-based and select system of the ships that should come go in and out. In parallel, we saw that Gulf countries should keep investing in alternative logistic routes, rather through the Red Sea or pipelines. But this last option is something that we should see working on a mid to long term. So once again, the key variable for your prices is how long the Strait of Hormuz remains blocked.
I guess we'll have to wait and see. Bruno, thank you so much for joining us. And thank you to our viewers for watching. If you want to learn more on what to expect in the commodity world these next few months, I encourage you to visit our platform using the QR code on the screen. Till next time.